Welcome to another deep dive. Today we're going to be tackling a pretty interesting concept, weaponized liquidity. We're going to be looking at a research report titled, Will Liquidity Be Weaponized? Who sounds intense, right? But we're going to break it down for you, see if this whole idea holds any water. That basically we're going to be exploring how something like liquidity, which seems pretty fundamental, might actually be manipulated, possibly even for political reasons, and then we're going to talk about how that could impact the economy. So get ready for some aha moments.
It's a really fascinating topic, and one with some pretty big real-world implications for investors and the economy in general.
Now, the report we're looking at dives into how to figure out where we are in the business cycle. Using some alternative indicators, they argue that just relying on government data might not be enough to get the whole picture.
Right. And they suggest that we should be looking at some market indicators, like the energy efficiency ratio, which is basically the ratio of the stock market to oil prices compared to its 7-year moving average. So a higher ratio usually means we're in a boom, and a lower ratio points towards a bust. It basically tells you whether or not companies are still generating value, even with rising energy costs. So if you see stock prices going up faster than oil prices, that's a good sign for the economy, like a real-time check on economic health. But what about inflation? How do we keep track of that?
Well, the report talks about currency debasement as a key indicator for that. This compares the price of gold in fiat currency to the total return of the government bond index, again relative to its 7-year moving average. Think of it like this. If that ratio is higher than average, it suggests that the currency is losing value. And we're probably in an inflationary environment.
So gold doing better than bonds, red flag for inflation. Sounds like these alternative indicators could be pretty helpful for investors. If they're trying to get a clear picture of what's really going on in the economy. Oh, absolutely. Especially when we're talking about the possibility of manipulating something as important as liquidity.
Which brings us to the heart of our deep dive. The report talks about this thing called the Global Liquidity Index, or GLI, as a way to measure global liquidity. And they're predicting that it's going to peak around September 2025, after bottoming out back in December 2022. So what does this liquidity cycle mean for us?
Well, think of liquidity like the oil that keeps the economic engine running. When there's plenty of liquidity, the markets tend to do well. But when liquidity dries up, things can get volatile, risky.
Kind of like a car sputtering when it's low on fuel. Not a smooth ride at all.
So how does this tie in with the idea of weaponized liquidity? Are they saying that this natural cycle is being messed with somehow?
Yeah, that's basically the argument. They're saying that governments and central banks might be influencing the flow of liquidity, maybe to try and control the business cycle, or even, sway elections.
Wow, that's a pretty big claim. They gotten any evidence to back that up? Well, they definitely tried to. They point to things like the Federal Reserve's rate cut, 50 basis points back in September 2024, which went against the traditional Taylor rule, the guideline for setting interest rates. And they see the timing of that cut right before the November election really raises some questions about their motives.
So they're implying that the Fed might be putting political interests ahead of sound economic policy. That's pretty controversial.
Yeah, it is. And the report dives into some other examples, too, to try and support this idea. For example, they talk about the Federal Reserve's response to that liquidity crisis we had back in September 2019. Remember when overnight lending rates suddenly spiked because of that sudden drop in reserves?
Oh, yeah, that was a pretty wild time in the markets. What do they have to say about the Fed's actions back then?
Well, they point out how the Fed jumped in with these massive repo operations, pumping liquidity back into the system to calm everything down. And while it definitely helps stabilize things, the report argues that it shows just how much power the Fed has to manipulate market conditions.
So they're saying that the Fed might be intervening in ways that go beyond just setting interest rates. But wouldn't that be hard to do consistently, especially on a large scale?
Well, that's where this idea of shadow liquidity comes in. The report argues that central banks can subtly influence the markets through all these backdoor channels, even while they're publicly claiming to be tightening things up. It's kind of like a magician using sleight of hand to make things appear different than they really are.
So a disconnect between what they're saying and what's actually happening behind the scenes, that definitely adds another layer to this whole weaponized liquidity thing. But do they give any specific examples of how this shadow liquidity actually works?
They do. And to understand that, we need to go back to what happened after the Silicon Valley Bank and Signature Bank failures. So after those bank failures back in 23, the Fed created this program, the Bank Term Funding Program, BTFP they call it. and basically let banks borrow money from the Fed at pretty good rates, using their holdings as collateral.
So kind of a safety net for struggling banks. And what's the problem with that?
Well, the report suggests that some banks might have taken advantage of this program, using those funds not just to stabilize themselves, but also to make a profit, some people even say. They use that money to speculate in the stock market.
So taxpayer money potentially fueling market speculation. That's definitely something to think about. What happened to the BTFP after the election, though?
Well, that's where things get really interesting. The program actually stopped issuing new loans in March 2024, right before the election. And after the results came out, we saw a pretty rapid decline in the BTFP, like a 62% annualized rate of decline, according to the report.
Wow, that's a huge drop.
Yeah.
Are they suggesting that the Fed might have been propping up the banking system with this program just to create a sense of stability before the election and then quietly pulled back the support once it was over?
Yeah, it's one of the theories they put forward. And it definitely fits with their argument about weaponized liquidity. They also mentioned a recent speech by the Fed chair, where he talked about a bumpy path ahead for interest rates, which suggests that the Fed might be having some trouble controlling inflation.
Okay, so we've got potential manipulation of liquidity, a bumpy road for interest rates, and signs that the Fed might be more focused on short-term stability than actually fixing the underlying problems. What does all this mean for investors? How are they supposed to make sense of all this?
Well, the report doesn't exactly paint a rosy picture. They're predicting that all of this, combined with the declining liquidity, could lead to even more volatility in the markets,
Yeah.
especially in the stock and bond markets. And volatility, as you know, can be a real problem for investors.
Yeah, for sure. Those big swings in the market, they're never any fun. But beyond market volatility, what are some of the bigger economic consequences of this whole declining liquidity thing?
Well, the report argues that declining liquidity can weaken financial market performance overall, particularly for the S&P 500. They highlight this negative correlation between the year-on-year change in shadow liquidity and the year-on-year change in S&P 500's returns.
So as that shadow liquidity dries up, the stock market takes a hit. Not exactly a good sign.
No, it's not. And it can have a ripple effect throughout the whole economy, impacting consumer spending, business investments, even job growth.
Okay, so this is a lot to digest. And the report doesn't stop there. They also bring up this thing called the bank-to-bond ratio as a possible indicator of economic health. Can you explain what that is and why it matters?
Sure. The bank-to-bond ratio is essentially the market value of banks compared to the value of the country's bond market. The report says that. Tracking this ratio against its 7-year moving average can give us some valuable insights into the economic outlook.
So how do we interpret this ratio? What does it tell us about the economy?
Well, when the ratio is above its moving average, it suggests that the economy is in pretty good shape. Banks are lending, businesses are borrowing and investing, things are generally moving along nicely. But when you see that ratio dipping below its average, it could be a warning sign.
Like a canary in the coal mine, signaling that trouble might be brewing.
Exactly. And if you remember, all that talk about declining liquidity, well, the report connects those dots, pointing out that negative year-on-year changes in shadow liquidity have historically pushed that bank-to-bond ratio below its 7-year moving average.
It sounds like they're making a pretty strong case that declining liquidity, maybe even manipulated by central banks, could have some pretty serious consequences, both for the financial markets and the economy as a whole. But they do offer a potential solution, right? They talk about gold being this anti-fragile asset. What's that all about?
Yeah, that's a really interesting part of the report. They argue that measuring financial asset performance, just in US dollar terms, can lead to something they call monetary illusion. Basically, it means we might think we're wealthier than we actually are because we're not taking into account how inflation erodes our purchasing power over time.
It's like striking it rich with fool's gold. It might look shiny, but it's not the real deal.
Exactly. And that's where gold comes in. They argue that gold, being a finite resource with inherent value, can help us see through that monetary illusion and make better investment decisions. They also point out this interesting historical pattern. Negative year-on-year changes in their USD liquidity proxy index have often happened at the same time as the S&P 500 to gold ratio falling below its 7-year moving average.
So when liquidity dries up, the stock market tends to underperform compared to gold. Sounds like gold could be a good hedge against economic turmoil, especially when you factor in this whole liquidity manipulation thing.
Yeah, that's their argument. And they even go a step further, saying that gold can act as a hedge against government risks and banking instability. They point out that unlike fiat currencies, which governments can just print whenever they want, gold is a scarce resource. You can't just create it out of thin air. And that scarcity makes it a valuable hedge against government policies that could lead to inflation or currency devaluation.
So it's like an insurance policy
Hmm.
against irresponsible government actions. But how does gold protect against banking instability?
Well, you know those bank runs we talked about earlier. When people panic and lose faith in the banks and rush to withdraw their deposits. Well, gold being a physical asset, that's outside the banking system. It holds its value even when banks are failing. It gives people a sense of security when trust in those traditional institutions erodes.
So in the middle of all this potential economic chaos and this whole liquidity manipulation thing, gold emerges as a safe haven. That's a pretty convincing argument. But how does this translate into actual investment advice? What are they recommending investors do to navigate this complex environment?
Well, that's exactly what we're going to cover. In the final part of our deep dive, we're going to explore their investment recommendations in light of this potential economic shift and that looming debt bomb we touched on earlier.
Don't miss it. We'll be back to unravel those final pieces of the puzzle. All right, so welcome back to the final part of this deep dive into weaponized liquidity. Remember that massive amount of U.S. public debt maturing in 2025 we talked about earlier, over $6.8 trillion.
Yeah, it's a crazy number. To put it in perspective, that's enough money to stack dollar bills to the moon, back to Earth, and almost to the moon again.
That's a ton of debt. How does this play into everything we've been discussing with liquidity and the potential for things to take a downturn?
Well, it definitely complicates things. When this debt matures, the government has to refinance it. Basically, they got to issue new debt to pay off the old debt. And that creates a huge demand for capital. And if that happens when liquidity is already declining, like the report suggests, it could make the problem even worse.
So it's like trying to fill up a swimming pool with a hose that has a leak. The demand for capital could outstrip the supply and push us closer to that inflationary bust scenario.
Exactly. And remember that inflation we've been talking about. That just adds fuel to the fire.
Right. If inflation keeps going up, the government might have to offer higher interest rates on that new debt to attract investors.
Exactly. And higher interest rates can slow down the economy, potentially leading to a recession. It's a vicious cycle.
So we've got declining liquidity, possibly manipulated by central banks, a huge amount of debt that needs to be refinanced, and persistent inflation, a recipe for economic turmoil. What's the takeaway for our listeners?
The report really emphasizes the importance of being cautious and preserving capital in this environment. Remember that concept of return of capital. Now is the time to focus on protecting your wealth, not chasing risky returns.
So it's time to play defense, not offense. What about those specific investment recommendations we talked about? Do they still make sense, considering all this debt that's coming due?
They're actually even more relevant now. The report really doubles down on their advice to hold scarce assets like physical gold, silver, and commodities. These assets can help protect you against government risks and potential currency devaluation.
So gold is still a safe haven.
Absolutely.
Yeah.
They also reiterate their preference for energy-related stocks over tech stocks, especially with the potential for rising energy prices and an inflationary bust.
And what about bonds?
They're still cautious about long-dated government bonds, especially with that huge amount of refinancing coming up. They suggest sticking with short-dated, high-quality corporate bonds for the fixed income part of your portfolio.
Well, we've covered a lot of ground in this deep dive. From the complexities of the business cycle to the controversial concept of weaponized liquidity and the potential impact of that massive amount of debt maturing in 2025. It's been quite a journey.
It definitely is a lot to take in, but knowledge is power, especially when it comes to navigating the financial markets. Remember, the future is always uncertain, but we can learn from the past by analyzing the data and maintaining a healthy dose of skepticism.
Great advice. Keep questioning, keep learning, and keep exploring. And remember, listeners, this is just the start of the conversation. We encourage you to dig deeper into this topic and share your thoughts with us. You can find us on social media, send us an email, or tune into our next Q&A segment. Until then, happy investing.